At 52, Mark thought he was finally doing everything right. Every payday, money went into his 401k, his balance was growing, his employer was contributing, and for years, Mark told himself the same thing millions of Americans tell themselves: my retirement is taken care of. Then one afternoon, he opened his 401k account and realized something uncomfortable. The biggest problem with his retirement plan wasn't that he wasn't saving. It was that some of the decisions he was making inside that 401k were making his original mistakes harder to recover from. And the strange part is, his 401k wasn't necessarily the problem. The way he was using it was, maybe you've done something similar. Maybe you stopped contributing during a difficult year. Maybe you borrowed from your 401k. Maybe you picked investments because they felt safe. Maybe you ignored the fees because they looked too small to matter. Or maybe you simply assumed that because you had a 401k, you were automatically on track for retirement. That's where this story begins. Because a 401k can be one of the most powerful retirement tools available to an American worker, but it can also give you a dangerous feeling of security. And sometimes, the biggest retirement mistake isn't the decision you make. It's the decision you make because you believe your 401k will fix everything later. Think about a family where the father spent decades working for the same company. Let's call him Robert. Robert had watched his father struggle financially after retirement, so when his company offered a 401k, Robert joined. He wasn't reckless. He wasn't trying to get rich. He was simply trying to avoid making the same mistakes his father had made. Every month, money disappeared from his paycheck and went into the retirement account. For years, Robert barely looked at it, and honestly, that felt responsible, until his daughter needed help with a major expense. Robert looked at his 401k and saw something that looked almost like a bank account. Money was sitting there, money that belonged to him, so he borrowed from it. At first, it felt like a smart solution. He wasn't putting the expense on a credit card, he wasn't taking money from a bank, and he was paying the loan back. But something important had changed. The money he had mentally labeled as retirement money was now doing a completely different job. And that's one of the first traps of a 401k. Because once you've spent years watching the balance grow, it can start to feel less like a future retirement fund and more like an emergency account with a very large balance. The IRS allows many 401k plans to offer participant loans, but the rules matter. Generally, a qualifying plan loan can be up to 50% of your vested account balance, with a $50,000 maximum, and typically must be repaid within 5 years unless an exception applies for a primary home purchase. But here's the part people often underestimate. When you borrow from your retirement account, the problem isn't simply the repayment, it's what that money might have done if it had remained invested. And that's where a seemingly small decision can become a much bigger retirement problem. Imagine Robert is 52. He borrows money from his 401k. The payment comes out of his paycheck. So he thinks, I'm paying myself back. Technically, money is going back into his retirement account. But the years when that money isn't invested can still matter. And suddenly, Robert isn't just dealing with the expense that caused the loan. He's also dealing with a retirement timeline that has less room to recover. But borrowing isn't the only trap. There's another one that looks almost harmless, and it can happen every single month without you ever seeing a bill. It's called a fee. The Department of Labor warns that 401k fees and expenses affect investment returns and therefore can affect the amount of retirement income your account ultimately provides. These costs can include plan administration expenses and investment-related fees. The dangerous part is how invisible they feel. You don't receive a dramatic notification saying, your retirement just lost money because of fees. Instead, the impact can quietly appear inside the account. A little here, a little there, year after year. And because the number looks small, people ignore it. That's exactly what Robert did. He worried about market crashes. He worried about inflation. He worried about whether he was saving enough. But he never asked a simple question. What am I actually paying to keep this retirement plan running? And that question matters, because retirement mistakes rarely happen in isolation. One mistake creates pressure. That pressure creates another decision, and that decision can create another problem. Robert's 401k loan wasn't necessarily the end of his retirement plan, but now he had less flexibility. If an unexpected expense appeared again, he might be tempted to borrow again. If the market fell, he might panic. If his paycheck became smaller, he might reduce contributions. And slowly, the retirement account that was supposed to protect his future could become part of a cycle of financial decisions that made the future harder to protect. But there's an even bigger mistake hiding underneath all of this, and it's one that has nothing to do with loans. It has to do with what Americans expect their 401k to do for them, because saving money is only the beginning. The next question is much harder. Is the money actually positioned to serve the retirement you're imagining? That's where another family story begins. Robert's brother Daniel had a completely different approach. Daniel never borrowed from his 401k. He never stopped contributing for long. And whenever the market dropped, he told himself he was thinking long-term. But there was one problem. He chose investments almost entirely based on what made him feel comfortable. If something sounded complicated, he avoided it. If something had performed well recently, he liked it. If the market became frightening, he moved toward what felt safer. Daniel wasn't irrational. He was human, and that's precisely why retirement investing is so difficult. Your 401k doesn't just hold your money, it puts you in situations where your emotions can influence what happens to your money. When markets rise, confidence can make people take more risk. When markets fall, fear can make people abandon a strategy at exactly the wrong moment. And because retirement accounts are designed for long-term saving, a short-term emotional decision can affect a much longer timeline. This is why a 401k statement can sometimes create a strange illusion. You see a number, you feel either rich or poor depending on what happened recently. But retirement isn't a single number. It's a future stream of expenses: housing, food, healthcare, transportation, taxes, and years of life after the paycheck stops. So the real question isn't, how big is my 401k today? It's, how well can this money support the life I want when I no longer have a paycheck? That's a much harder question. And it's also why contribution decisions matter so much. Your 401k can only grow from what actually gets into the account. The IRS describes 401k contributions as salary deferrals, meaning money you choose to put into the plan instead of receiving it in your paycheck. Employer contributions may also be part of the plan, depending on its rules. SEN. But imagine someone gets a difficult year at work. Their mortgage rises, groceries cost more, insurance costs more, their kids need help, so they reduce their retirement contribution. It feels temporary, just until things calm down. But 1 year can become 2, 2 can become 5, and the longer the pause lasts, the more difficult it can become to rebuild the habit. Now add another psychological problem. People tend to think about retirement in terms of the money they can see today. They don't naturally think about the money they might have had if they had continued investing consistently. That's invisible money. And invisible losses are easy to ignore. This is why the 401k can sometimes make a retirement mistake worse. Not because the account is designed to hurt you, but because it can hide the consequences of your decisions behind one simple number: your balance. And there's another decision that can become especially expensive: taking money out too early. The IRS says early distributions from retirement plans can trigger an additional 10% tax in many situations. Although exceptions exist CO. Imagine someone reaches into the account during a financial emergency. They see $20,000. They think, I have $20,000. But depending on the circumstances, the amount they actually get to use can be affected by taxes and potential penalties. And more importantly, that money is no longer sitting inside the retirement account. The future doesn't get to use it either. That's the part people rarely visualize. When you take money from retirement today, you're not only spending today's dollars, you're also giving up the future role those dollars could have played. And this is where the story gets uncomfortable. Because sometimes people aren't making bad decisions because they're careless. They're making them because life gives them a problem that feels more urgent than retirement. A broken car feels urgent. A medical bill feels urgent. A job loss feels urgent. A family emergency feels urgent. Retirement feels like something happening years from now, and the human brain has a very hard time sacrificing today's certainty for tomorrow's possibility. That's why the strongest retirement plan isn't simply the one with the highest theoretical return, It's the one that can survive real life. But there's still one more problem. One that can affect even people who save consistently. Never borrow, and never panic during a market downturn. Their 401k might still be quietly costing them more than they realize. And once you understand that, the entire retirement account starts to look different. The Department of Labor breaks 401k fees into different categories, including plan administration expenses and investment-related expenses. And importantly, the Labor Department doesn't say that the cheapest option is automatically the best. It says fees are one factor among several that participants should consider. Woo, that's an important distinction, because the goal isn't to obsess over every tiny expense. The goal is to actually understand what you're paying for. Think about your phone bill. If someone told you they were paying $15 more every month, you might shrug. But retirement isn't 1 month, it's potentially decades. And that is why small differences can become worth examining. The same principle applies to the investments inside the plan. A fund isn't automatically good because it appears on your 401k menu, and it isn't automatically bad because another fund has a lower fee. The question is what you're actually getting, what risks you're taking, and whether the investment fits your long-term plan. That sounds simple, but here's the uncomfortable part. Most people don't review their retirement accounts like they review a mortgage. They don't sit down every year and ask, is this still the right setup for me? They often just keep contributing, and contributing is good. But blindly contributing isn't the same thing as having a retirement strategy. So what does a better approach look like? It starts with something surprisingly boring. Know what's inside your 401k? Know how much you're contributing? Know what your employer contributes under the plan's rules. Know whether you're vested in employer contributions. Know what investment options you actually own, and understand the fees and expenses associated with them. Then look at your retirement timeline. If you're 25, your decisions have one kind of consequence. If you're 55, they have another. The closer retirement gets, the less room you generally have to recover from major mistakes. And then there's the question of loans. Before borrowing from a 401k, understand what happens to the account and what happens if you leave your job or fail to repay according to the plan's terms. The IRS warns that a loan that doesn't meet the applicable requirements or goes into default can be treated as a taxable distribution, LO. That doesn't mean every 401k loan is automatically disastrous. It means it deserves to be treated like a serious financial decision, not free money, not an ordinary checking account, and not something to use simply because the balance is there. Now go back to Robert. At 52, he still had time. He couldn't undo every decision he'd made. He couldn't recover every dollar that might have been invested differently. But he could change the way he looked at the account. His 401k wasn't a retirement guarantee, it was a tool. And like any tool, its value depended on how he used it. That realization changed something important. Instead of asking how much money is in my 401k, he started asking, is this account helping me build the retirement I actually want? That's the question more Americans should be asking. Because your 401k isn't automatically making your retirement safer. Your decisions inside it matter. Your contribution habits matter. Your investment choices matter. Your fees matter. Your behavior during stressful markets matters. And your decision to borrow or withdraw money can matter even more. The good news is that none of this means you're doomed if you've made mistakes. A retirement account isn't a test where one wrong answer ends the exam. You can review it, you can learn, you can make adjustments, you can build a plan that doesn't depend on everything going perfectly. And maybe that's the biggest lesson. The most dangerous 401k isn't necessarily the one with a small balance. It's the one that gives you confidence without giving you understanding. Because when you understand what's happening inside the account, the 401k becomes what it was supposed to be all along. A tool helping you build your future, not a reason to stop thinking about it. And years from now, when the paycheck finally stops, you won't care whether your retirement plan looked impressive on a statement. You'll care whether it actually worked. Subscribe to MSBT Finance for more documentaries about the money decisions shaping America's future.